Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Brien Lundin. We're going to be talking about, well, the continued run higher in gold now, right at pretty much that $2,700 level. Silver is over $32 an ounce. Continues to be a strong precious metals market, as well as a pretty strong commodities market, as we have also seen copper up above 450. And look, we'll talk about some of the stocks where Brien is focused as it continues to very much be a stock picker's market for the gold equities. Brien is the editor of the Gold Newsletter, also our host down at the New Orleans Investment Conference this year, happening November 20th to the 23rd. Click the link in the show notes to find out more about that conference. Brien, nice to chat with you again. Let's talk about gold, that continued run, $2,700. We have heard that some more investors are taking part, especially in the Western markets, and it's actually been very interesting to see during Western trading hours, gold moving up, any dips being bought. What's your takeaway from this continued strength in gold, and are any new investors coming into the space?
Yeah, I think that we are seeing the signs of some new investors coming in, particularly the speculators, the Western investors, the generalists. They're coming into GDX initially and GLD, the gold ETF. Now, we started to see the holdings in GLD rise and started to see the inflows early July, and that was the first sign that they're starting to kind of price in, or we're starting to price in the pivot. We're starting to see GDX as well leverage the moves in gold, which is an important confirmation that we are in a long-standing kind of a secular bull market. The other important confirmation in that regard is silver outperforming, and we have generally seen that over the past couple of weeks, that silver is dramatically outperforming gold, with a few notable exceptions. Like as we speak earlier this week on Monday, we saw a down day in silver when gold was up, but the next day, silver just absolutely bounced higher and gold did as well. So, it's a steam train right now, and I'm starting to see some people, some traders out there say that they're starting to hedge or go short because it's oversold, overbought rather. But, sometimes you just don't want to get in front of a steam train. And, anytime you doubt gold since it started this bull market in early March, it has quickly, handed it to you and proved you wrong. So I'm amazed, like the rest of the market, and I'm amazed that the mining stocks have not been re-rated according to the new gold prices.
Well, Brien, let's dig into that idea a little bit more because while the gold stocks have started responding, at least the producers, and to some degree, some of the highest quality development stage companies have started getting a bid, they haven't responded like they have in prior cycles. And so this seems to be the topic that comes up with everybody at every conference and every discussion is why aren't the gold stocks doing better? And when you go down to the juniors, a lot of them still haven't even really got off the mat yet. But when you look at GDX, it's a collection of the gold producers. We've got $1,000 margins in the third quarter here. It's really the highest margins the sector has seen. And yet GDX, while it's been outperforming gold lately, it hasn't even got above the 2020 peak when the margins were only 800. And it's nowhere close to that $50 to $65 level that we saw back in the prior cycle in 2010 and 2011 and 12. So what is it going to take to get more momentum into, I guess, the passive side, the ETFs, to then finally filter down into the juniors?
Yeah, I think it's going to just take time. I think we need a bit more time, and that's, I know how silly that sounds. We've been talking patience for so long, but we are starting to see GDX outperform gold, even though gold has been performing very well. And that's starting, it has to start somewhere. And I think that the market cannot ignore these kinds of margins, that kind of cash flow forever. Eventually they will come around to it. The issue now is that unlike previous cycles, gold and the mining stocks have a lot of competition. We have competition of crypto, we have competition with the AI thing. With generally speaking, tech stocks in the US and the stock market in general. Also, specific to the metals and the miners, there are ways to get leverage, not just on the futures exchange, but with futures and options but there are 2x ETFs, 2x funds. There are ways to leverage the market that we really didn't have in the early 2000s or even post the great financial crisis. So there's a lot of competition for mining stocks. And of course, mining stocks are famous for not performing or having a lot of issues in terms of, treating shareholder capital, et cetera, et cetera. But again, I think it's going to happen. The kind of cash flows that they're spinning off right now, as far as the producers, just can't be ignored forever.
So, Brian, let's talk about what the companies can do then, because they don't control the underlying precious metals price. They continuously try to get their costs in line. But the other thing they can do is go out there and grow. They can only grow production so much because mining is hard. It's difficult to ramp up. But they can go out there and acquire ounces and they can acquire production. It's what we've seen majors do is use their capital and their shares to acquire either development plays, ones that they can build in the near term, or ones that are already producing. Does this help draw in new investors? Because look, growth in margins because of the metals price is a absolute bonus for these companies, but go out and grow yourselves too.
Yeah, I think that's obviously a strategy in a bull market or before bull market, ideally, to have the foresight to go out and grow and experience the rewards of a higher metals price. But I don't think they're that forward thinking, and I don't think investors are that forward thinking. I don't think they're buying these majors because they're replacing reserves. I think they're focused on those cash flows. I mean, Barrick has a lower production profile than it did 20 years ago. So these are not typically growth stocks, at least
But
not.
that's the thing, right? Let's get some growth in the sector. That's what
They,
draws in investors.
well, I think what draws in investors are rewards. And one of the things, near-term rewards. And one of the things that mining companies started to do over the last 10 years or so when they weren't getting much attention from generalists is dividends, and focusing a bit more on dividends when they had the cash flow to support that. At these price levels or these margins and cash flows, if these majors don't start getting any love from generalist investors, the speculative end at least, I think they're just going to start spinning out dividends because they benefit from that as well. And that attracts an entirely new sector or different sector of investor. I believe that may happen, and I think that's an avenue that they are positioned to pursue. And I'm curious to see if that's going to happen.
Well, Brian, just to the point of the developers, printing this cash and the theme of growth that Corey brought up, we have seen a lot of M&A this year. I think, earlier in the year by June, we'd already seen about 14 deals. Now we've seen about 18 deals. A lot of them have been some of these higher profile, mergers of equals from larger companies, but we have started seeing some of it move down the food chain. Most recently, the Filo acquisition by Lundin Mining and BHP, or the Goldfields acquisition of Osisko Mining, got the animal spirits going in some of the development stage companies that have defined resources, they have economic studies, and to your point, with higher prices, these economic studies are starting to look a lot better. We were talking about metal sensitivities and how companies market off mic. Maybe just share your thoughts on what you see in some of these development stage companies that now don't just have good economics, they have insanely good economics.
Yeah, in particular, we were talking about these out of the money optionality plays, which were, the darling of the diehard gold bugs and silver bugs like me, and about the only comparison I have of Eric Sprott is that I'm a gold bug and silver bug like he is. So these plays where the companies acquired really large resources when they were out of the money and uneconomic and cheap to acquire, they built up these banks of metal in the ground. They're not the kinds of companies that the geologists really liked or respected in the industry because they didn't work at current metals prices. But if you were a long-term bull, you liked them because the valuations would explode at higher gold prices. Well, now we've gotten those higher gold prices. Every one of those out of the money optionality plays is not out of the money any longer. They are well in the money. The economics are absolutely screaming because these are very large resources. So they've got mine lives, they've got large potential cash flows out there at current gold prices. But the market is still gobsmacked by this rise in gold. It was about 2 weeks ago or 3 weeks ago where I put out a piece saying, $2,500 gold changes everything. Last week I revised that and I said $2,600 gold changes everything even more and did a strike through of the $2,500 price. Now, we're at 27. So we're stunned by this. I'm stunned by this. The market has yet to re-rate these companies, but those margins, profit margins for these potential projects are tremendous. And I think that's an area where an investor can get the kind of 4 or 5x potential returns of a discovery play with much less relative risk because these are companies that already have the resources. And the resources that the market has yet to recognize are economic.
Yeah, fact of the matter is at these prices, man, oh man, if your resource isn't economic, it shouldn't even be around. You shouldn't even be spending money on it. But Brian, to the point about re-rating the whole sector, you can argue we haven't really seen a re-rating in any part of the food chain for these precious metal stocks because it continues to be a stock picker's market. When you're looking at these optionality plays that are now in the money, these projects would make money at current prices. What do you want to see a company do with them? Is it continue to explore? Is it cut back and save their money, not blow money? Is it do something else that you think could separate these companies so that they actually are the ones that could get re-rated?
Yeah, what they need to do, and by and large, what the smartest ones have done, well, they further defined their resource and done what they need to prove that the resource is there. But the ones that have spent their time working on permits and checking off those risk boxes here, local relations, permits, environmental studies, etc., to make their project more attractive to a major. So a major can come in and just say, well, this is, signed, sealed, and delivered, wrapped in a ribbon and a pretty bow and ready to go. Those are the projects that will get attention first. And the ones that are more technically sound and have done that homework and that groundwork, I think those are the ones that will top the list. And there are a number of those companies out there that I'm talking to every day, every week that have done that and that are, further along that development pipeline where they can attract major investment. Another thing that's kind of interesting, not so much in gold, but in other metals, is the entree of OEMs and other groups with really big money that aren't shocked at $1 billion capex figures and the like. $1 billion is a lot in the mining industry at any level of the mining industry. But when you get into technology and the likes, it really isn't. So there are groups out there looking to secure supply and making those kinds of investments. And I think that's another one of these trends in the industry that we're going to see blossom over the next couple of years.
Well, Brian, just to that point, do you think that we need to see more mergers of equals to mass up into larger companies like we just saw AngloGold Ashanti go after Centamin for their mine in Egypt to become, they were already a major, but now they're going to be a larger major. We've seen that happen with Barrick and Randgold and with Newmont and Newcrest to keep bulking up in size. Are there just not enough large cap or I guess larger market cap companies in the space to even attract generalist investor? Because they're not going to drive down into XYZ drill play. They're too small. They're nano caps, but they could drive into some companies that have the multi-billion dollar valuations. Do we just need to see more consolidation and bigger companies to get the wheels turning?
Yeah, I don't know that we really need to see that, frankly, because we've already had so much of that. There aren't that many. From a junior mining stock investor perspective, like I have, the more mergers you have of these larger companies, the less or the fewer potential buyers you have for these juniors. So, maybe the sector in general would need that to get some of the big institutions involved. But I don't think we as junior mining junior resource investors need to see that. And those big companies, those big groups could just buy the indices as easily and get as much liquidity, which, eventually will help at least the share prices of the individual components. I think what we need is more interest from those companies, those funds that are doing their homework and aren't really intimidated by the level of detail necessary, the level of knowledge and insights and education necessary to get into the sector. And eventually, as junior mining investors, we need those big funds that have more dollars than cents, that are willing to come in here and pay what in our minds are elevated levels, the companies that we own.
Hey, it all starts from the top too, right? The better the majors can do, that will filter down, but that also shows investors coming into the sector, which I think there have been some, but they're just taking a very selective approach. And look, we also need more money coming into some of these resource funds that are still around that we're hearing are, I think, mostly flat right now when it comes to redemptions versus injections of cash. All that helps out the sector. And hey, it's a process. Arguably, we're still early on. I think we've just been over the last decade conditioned to thinking that these bull markets last only about half a year, just over half a year. And that's really where we're at now. This one seems a whole lot different in nature. Brien, as always, thank you for joining us. Brien Lundin, again, the editor of the Gold Newsletter and our host at the New Orleans Investment Conference, happening November 20th to 23rd. Click that link in the show notes. Brien, great chatting with you. Thanks for your time today.
Thanks, guys. Appreciate it.